It's true, about 90% of the startups fail, which means only 10% survive. Not meaning to scare you, but yes, this module which we currently dealing with is one of the most important ones, and if you don't get this right, then you might go on the 90% side of the Venn diagram, which we definitely do not want, do we? So let's move on to finding, funneling, and funding. This is one of the most important modules that you'll be dealing with, so do pay attention. There are many factors that will transform your startup's idea into the business you've always envisioned. You need a fantastic idea that is unique in your specific industry, not to mention an investor in your startup. You need a business and a marketing plan. And most importantly, you need the right knowledge on how to raise capital and find investors. Whether you're crowdfunding or leaning toward the private investment market, choosing the right investors can make or break your company. Now, entrepreneurs make a common mistake when it comes to raising money for their startup. They don't start soon enough. You have to network in the finance community as you build your business, secure the right funding. It's very important to know who the right investors are for your industry. Consider the size and the round you're trying to raise. Think about whether you're going to use an accelerator or not. Decide whether you're looking for angel investors or institutional investors. Now, the different types of investors by company stage. There are a variety of investment opportunities for you to consider when trying to acquire funding for your startup. Depending on where your business is at its development, some funding options may make more sense than the others. So, how do you find the right stage? Shall we begin? So, starting at the beginning, obviously, is the idea stage. In this stage, the entrepreneur is still developing and fine tuning the concept of the startup and needs funds to complete essential tasks, such as creating a detailed business plan. Funds are typically raised through personal finances or close connections in its early phase. Moving on to the next stage is bootstrapping. Now, in bootstrapping, you are the investor. At the idea stage, it can be difficult for companies to attract outside financing. So, in many cases, it falls to the founder to provide the initial startup capital. While investing your own money can be risky, it allows you complete control of the business, void of any outside influence or conflicting visions. Funding a startup with personal finances is also a way to safeguard yourself from debt should the venture not succeed. Now, as the business grows, however, it is likely that you will not be able to sustain it with your own money and will eventually need to bring in outside investors. Here comes friends and families. Most entrepreneurs receive substantial financial assistance from friends and family in the idea stage. These tend to be the true believers in your project or those who are closest to you and want you to succeed. While these investors tend to be easier to handle and less involved in the day-to-day operations, accepting money from those closest to you can also bring about personal tension and stress. Friends and family may not be checking regularly for a return on their investment, but they will be anxious to get their money back as the company grows. So you'll have to very tactfully decide as to whom you're borrowing from, when you're borrowing it, and when will be the likelihood of returning it. So it should not result in a catastrophic clash between your family members, destroying your business and your relationship at the same time. So do keep that in mind and move forward. Moving on to the next stage, which is incubators and accelerators. Businesses in the pre-stage that show significant promise can apply to incubators or accelerators to receive a number of benefits. In most cases, if your company is invited to participate in one of these programs, you can expect a state-of-the-art work environment, business mentorship, strong industry connections, and for the most promising ventures, seed funding. So this is the place where you start your company, you get it started, and you get a catapult into the industry that you're looking for. So if you get this right, then your foundation is solid and strong, and your future is also secure. Moving on to the next stage, which is the seed funding stage. Now, before this, there's also a small pre-seed stage in which the entrepreneur might need additional funds to, sustain current growth and to perform tasks like market validation. An entrepreneur can continue to rely on funding operations from the idea stage in addition to exploring some new external avenues as well. This is just a side note that I'm supplying you with. It need not be a significant point or a substantive element that you need to keep in mind, but just something that you can probably take a note of. Pre-seed is still a relatively new phenomenon in capital fundraising that has come about as a response to investors dedicating less money to new ventures in the seed stage. Entrepreneurs are continuing to refine their approach to funding in this stage as new lessons and best practices are being discovered regularly. Now, coming on to the seed funding stage. After the pre-seeding stage, it's time to actually plant the seed. The first in the startup funding stages is seed funding. You can consider the seed funding stage as an analogy of planting a tree. Ideally, the initial funding is the seed which follows or allows any startup to flourish. Seed funding allows a startup to fund costs of product launch, get early traction through marketing, initiate important hiring, and further market research for developing product market fit. Many startups consider the seed funding round is all that is necessary to successfully get their startup off the ground. This is your launching pad. If you get this right, means you've had a great beginning and you're off to a great start for the at least next 3 to 4 years. Now, the potential investors of seed stage can be your friends and family, angel investors, early stage venture funds, or through crowdfunding. Now, the great thing about crowdfunding for startups is that it opens opportunities for investment to literally everyone. By using websites such as Kickstarter, GoFundMe, Indiegogo, you can pitch your business idea or product and let people around the world donate money without having to seed any equity in your company. Crowdfunding is a hands-off approach to investment when it comes to impacting your actual day-to-day business operations. While it may seem like a grassroots approach, many startups have received millions of donations. Now, moving on to our main Series A funding stage. Series A stage is the first round of venture capital financing. By now, the startup must have a developed product and a consumer base with consistent revenue flow. Now it's time for them to offer Series A funding and optimize their value offerings. This is an ideal opportunity that allows startups to scale themselves across different markets. In this funding round, it's significant to have a plan that will generate long-term profits. Many times, startups come up with great ideas that can generate a substantial amount of enthusiastic users. However, they do not know how to monetize it in the long run. So, even if you have a great idea and it has an immense amount of potential, if you do not get the right funding at the right time, it can be a drastic decline in your growth and can lead to a catastrophic end. So, we don't want that to be. Now, moving on to few of the major investors and major terms or names of people that you will be, hearing in this domain. Moving on to the angel investor. Now, an angel investor is a high net worth individual who provides financial support to small businesses or startups in exchange for ownership equity. Angel investors focus on helping startups to grow rather than concentrating on profits the company make. This is the fundamental difference between angel investors and venture capitalists. We'll discuss the latter next, but mainly trying to point out the key differences between both. An angel investor will always look for the following in the business before investing. Now these are the people who don't do it only for the monetary gain. They have a passion, they're either in the same field or they genuinely connect with the CEO or the founder of the startup and want the idea to reach out to the world, which is why they invest in such ventures. So they look for these common traits, which checks their requirement and then they proceed forward. Few of them are they look for genuine belief and commitment of the founders. They also see the traction and scalability of your business. They, they also check if you have a good management team. They see the size of the target market that your product will be targeting. They check for reasonableness in evaluating your business plan, whether it sounds right, whether it's a feasible plan, an achievable target or not. And then finally, they obviously look for viable exit strategies in the nearest future or the time period that they have in mind. Now, next is a very common and famous terminology that you've heard regarding people, venture capitalists or VCs, as they're commonly heard or called as. Now, these people invest their money while risking losses and hence look forward to a much higher return or exit opportunity through acquisitions, which would give them a profit on their investment. Thus, to pick the right investor and get the funding, knowing the perfect ways of how to reach the venture capital is vital. In order to finalize a deal of venture capital funding into a startup, investors and VC firms carry out due diligence to assess the ability of the business idea to succeed, the entrepreneur's outlook and strategy in shaping the business, taking it ahead towards growth and profit, and earning the desired returns. Now, the founder in the position to approach investors with the idea. So, the next step in how to reach venture capitalists is making a good business pitch, clearly explaining the business idea, and defining the growth path of business through a proper plan and execution strategies supported with data, information, and documents. This is only possible when the startup or founder is ready with a well researched plan, good understanding, and clear vision of executing their idea. Following this, the task that remains is approaching and talking at length with the VC, presenting the pitch, and convincing the investor with it. So that's all, guys, in this module. Thank you.